Silver didn't rise quietly. It fell. Then it exploded to all-time highs. This wasn't demand. This wasn't manipulation. It moved for 6 reasons. This is why silver rose. Silver didn't rise. It didn't slowly trend upward. It didn't respond politely to news. It lost control. Prices surged, then accelerated. And then, without warning, silver dropped 10% in a single day. No war, no policy shock, no global emergency. Nothing obvious broke. And that's where this story actually begins. Because when markets move without reasons, it means the reasons are hidden. So here's the first question. If silver rose because of demand, why didn't it rise years earlier? Solar panels, electric vehicles, electronics, industrial electrification. These forces didn't arrive suddenly. They've been building for over a decade. Factories didn't wake up overnight. Governments didn't flip a switch. The demand was already there. Yet for years, the price barely moved. So what changed now? That question matters, because markets don't wait this long and then suddenly panic without something shifting underneath. Which leads to the second question. If markets are efficient, why did silver crash without bad news? Every headline blamed emotion, fear, speculation, retail panic. But emotion doesn't change settlement rules. It doesn't alter margin formulas. It doesn't rewrite exchange requirements. Systems do. Markets don't run on feelings. They run on processes. And processes fail quietly. That brings us to the third question. If nobody was wrong, what actually broke? Because silver didn't disappear. It wasn't destroyed. It wasn't banned. It stopped moving. Bars stayed in warehouses. Inventory stopped circulating. Supply existed, but access tightened. And when movement slows inside a system, pressure doesn't announce itself. There are no alarms, no breaking news, no countdown. Just silent accumulation. Positions stack, exposure grows, liquidity thins. The system keeps functioning, right up until it can't absorb the strain anymore. This is the part most people miss. Stress doesn't show up in prices first. It shows up in friction, in delays, in restrictions, in reduced flexibility. By the time price reacts, the pressure has already been there for months. This story isn't really about silver. Silver is just the surface. This is a story about how systems behave when they're pushed slowly, quietly, and then all at once. And the most dangerous stress is never the one everyone is watching. It's the one nobody measures. The rally didn't start with price. It started somewhere quieter. Far from trading screens, far from headlines. It started inside industry. Electrification didn't arrive as a shock. It arrived as a process. Power grids expanded. Solar installations multiplied. Electric vehicles became infrastructure. Each step added a little more demand. Not dramatically, consistently. Silver was pulled into this system silently. But supply didn't respond the same way. Because silver isn't mined on purpose. It's a byproduct. You don't open a silver mine just because demand increases. You wait for copper. You wait for zinc. You wait for lead. And those timelines don't change quickly. So while demand grew steadily, supply stayed inelastic. The gap didn't show up in price. It showed up in inventories. Warehouses absorbed the difference. Metal moved out quietly without triggering alarms. No shortage headlines. No emergency declarations. Just fewer bars in circulation. Logistics tightened next. Export restrictions. Shipping friction. Longer delivery times. Not enough to panic markets. Just enough to slow movement. And when movement slows, availability becomes selective. The price still looked calm. Systems still reported operational. But beneath the surface, pressure was forming. Month after month, metal was absorbed faster than it could be replaced. Nothing broke. Nothing failed. The system was doing exactly what it was designed to do. It buffered imbalance until it couldn't anymore. Pressure alone doesn't move markets. Access does. Until this point, silver still existed. It was mined. It was stored. It was accounted for. But it was becoming harder to reach. Export restrictions didn't remove silver from the world. They narrowed who could touch it. Delivery slowed. Guarantees turned into allocations. On paper, the price still looked calm. In reality, circulation was thinning. Then something structural happened. Exchange-traded funds stepped in. ETFs don't trade silver. They absorb it. When an ETF buys silver, that metal is removed from circulation and locked away to back financial units. The silver still exists, but it no longer participates in price discovery. It doesn't respond to demand. It doesn't respond to scarcity. It just sits there. This is where the system changed layers. Metal moved out of circulation and into long-term storage. With less silver available to move freely, the market grew sensitive. Small orders pushed price further. Normal demand caused abnormal reactions. That's when price stopped responding quietly. It started speaking loudly. Media noticed first, then everyone else. People didn't buy silver because they understood what broke. They bought it because it was rising. At this stage, price stopped reflecting reality. It started recruiting belief. And once belief enters a stress system, volatility becomes inevitable. By now, silver should have failed. Rates were high. Liquidity was tight. But silver isn't just a monetary metal. It's an industrial input trapped inside modern systems. Policy pulled one way. Reality pulled harder. At the same time, capital wasn't disappearing. Central banks locked gold away. Pressure didn't vanish. It rerouted. Silver was still open. That's why silver didn't rise for one reason. It rose because 6 pressures aligned. Some visible, most ignored. And when systems align, price moves last. Markets don't move randomly. Systems do. Money forensics.